it's Scott Bennett and Mike Olafson of Invest with Rules. Welcome to the midweek update. We're so happy you're here. Mike, happy Wednesday. How are you doing today, buddy?
I am well, especially considering the tumultuous nature of the markets. Doing pretty well. How about you, Scott? How you doing?
Yeah, we're doing okay despite the proceed with caution. What we're going to do today is talk a little bit about the moves in which we've made with Invest with Rules, so the investment moves, and we'll certainly cover some. There's always a bull market somewhere. We'll cover that and then some. Before we dive in, world's quickest disclosure, this is just information, hopefully education to present some ideas for you. It is not a direct solicitation to go buy or sell anything. Always do your due diligence, manage your risk, manage your financial plan. You know how all that stuff works. Okay, so very simply, what I wanted to do, and if this is one of our advisory clients, you can kind of fast forward a little bit. But I want to just talk a little bit about Invest with Rules and the model portfolio that we share that suits our risk tolerance and our rules and our risk management protocol. But I just want to share with you a little bit about what we've done over the last several days and weeks. And I just want to give you a quick summary because sometimes it's hard to see it on a day-to-day basis. But if we take a step back, we've done three major things. And the theme is playing defense. So, number one, we've built roughly 53% in cash in higher yielding money markets. We've taken it off the table. We've protected it. There's always the probability that this could get significantly worse. This is just the start of some pain, possibly. Why have we done that? Tariffs could certainly increase inflation. Well, who knows? They could get pulled back, they could get applied. The answer is no one knows. There's a lot of uncertainty. And you're starting to get a significantly large number of US growth, GDP, gross domestic product revisions down. So this is really interesting where inflation's in flux, growth is coming down. So what's the number one way to protect yourself is to very simply build cash. Mike, any thoughts on number one before I move to number two?
Yeah, I think folks have got to, based on their own plan, have got to consider is cash king or do you hedge? And we're going to talk about our hedging next. But as you're listening to us and looking at the actions we're taking, definitely adapt them for your own risk tolerance and your own plan.
Yeah, and I talked to a long time friend, and they were saying how their advisor took some of their cash needs over the next, call it like 6 months, and that's in cash. You can see the major difference in protection versus like liquidity for 6 months. This is very different. This is protecting the castle. And if you think about it, like that highway analogy I like to use is we were in the left lane when the market was at all-time highs. And then we started coming from the left lane of the highway. We went to the middle lane, and I would say we're pretty much in kind of in the middle to the right-hand lane at the moment. And number two, what we've done is we've hedged using inverse solutions that are liquid and low cost and not non-leveraged. These are inverse ETFs that, in essence, go up when the market goes down. And very simply, what we're trying to do is protect some longer term winners. And that's on the tech stocks and on the S&P 500. We'll go over some slides. And then we're simply holding what's working and what's outperforming. What's doing that? Very simply, it's definitely international stocks. It's fixed income, it's bonds, it's healthcare stocks, it's gold, it's insurance stocks. A lot of things are those are holding up quite well and they're working, so there's no real reason to make any massive changes there. But there's a lot of things that aren't working. Mike, any thoughts on two or three?
Yeah, it's interesting. I guess, Scott, let me ask you a question if you don't mind. I'm nowhere near as astute as you are on kind of macroeconomic situations going on. And it seems counterintuitive that, for example, international stocks, China, international, et cetera, would be actually doing well in this kind of environment with tariffs going into place. What's your take on that, if you don't mind giving it to us?
Yeah, I think a lot of it is if you just kind of block away the noise and you just say, what is their growth? So their gross domestic product, and is it growing comparative to their past, in essence, quarters? And then what is their inflationary outlook? And what's really interesting is that a large majority of Europe is in a growing environment comparative to comparables when you compare quarter to quarter, year over year. And they're in actually a slightly rising inflationary environment. They're in this robust environment where everything seems to work. That was like us a couple quarters ago, where you're seeing things like Tesla and Palantir and NVDA rocket up. That's the environment that they're in. That's why we have a full position on international. Growth is there, inflation's there. In the US, which is really interesting, inflation's actually coming down. And if you're a multinational company, what you really want to do is get as much goods in the US as fast as humanly possible before any tariffs come in. So that's going to cause a little bit of a spike, but inflation comparatively is actually going to be falling a little bit. And then now you're starting to see growth drop. So where the US is in a little bit of a comparable bad scenario and international's in a strong scenario. So if you take out the noise of what inflation sounds like to you and you look at those two macro factors plus you look at trend, the trend does not care about one thesis of what tariffs may
Yeah.
be. They care about now that is the safety play and that's why we're there.
Yeah. Yeah. No, I appreciate that. Makes sense.
So let's talk about some things that we've done over the last couple days and weeks. So here is a chart of small cap stocks. They're the most sensitive to growth slowing. They're the most sensitive to interest rate fluctuations because they have to borrow more money. So here's I'm going to use my mouse, a long-term trend, and it broke and it fell really hard. So this is the worst part of the market at the moment. It's in a short-term and a long-term downtrend. If you think about it, like the short-term trend's been going for about 12 days. 5%'s nothing. Just to put that in perspective of how risky any market really is. And the long-term trend just broke. So here's what we did. I just want to be clear, this is, and please manage your own scenario, but this is what we did in our advisory and on our newsletter is the hedging signal went really fast on us and it kind of spiked so fast that we simply decided to sell half here, sell the other half here, and now we're in this really kind of a sharp drop environment. And maybe 2 days ago, you that could be your low. The answer is no one knows. So here are the possible scenarios. Could you keep falling like a knife? It's possible. If the tariffs stay on, if growth keeps getting revisions down, if you're not getting any exciting earnings reports, there's still about 200 plus earnings reports this week. That's going to keep falling and falling hard, and maybe it kind of tests its friends down here in August to $80. Could it, in theory, fall and make a sharp jump and do a recovery? That's possible if the tariffs are taken off or revised. And then the question then, so we've gotten half and half out. So hopefully if it kind of comes back up, could it then get flushed down and get slammed down and go fall even harder than it was before? That's a correction. That's 10% plus. That's totally normal. Could it do a V-shaped recovery and kind of like nothing ever was wrong and it kind of climbs like it did during the Japanese yen carry trade nonsense? Yeah, then very simply we could always re-add a position and our cost basis would be in theory lower than what it is or lower than when we got out. Mike, any thoughts on small caps? And just we simply just said, you know what, defense here. This is a bad part of the market.
Yeah. Yeah. In those scenarios are laid out for example, what V2 could do, what small caps could do. What's interesting about what's going on now versus say 2 months ago is the market hates uncertainty. It just hates uncertainty. And it's a forward-looking type of lens into what's going on. And so is there any clarity in the future? That's the question. So we don't predict at all. But if somebody said, Mike, you have to make a bet on what's going on, I'm leaning towards uncertainty causing more volatility and likely to the downside. But we just don't know, to your point.
Yeah, and that's the beauty of trend following. You don't know. And here's the cues. This is the NASDAQ. This is the top 100 tech companies in the United States. They're mostly global. Short-term downtrend, long-term still in an uptrend. And you're getting it's getting kind of tough because you undercut this January
Yeah.
low. You're testing these lows over here from November. and previous. And very simply, here's what we did. So we added a hedge. So the ticker PSQ is the inverse of QQQ. So in theory, one reciprocates the other. Nothing's perfect, and there's no time when a hedge is the absolute perfect thing. It's hard and it's fast. It's a trade. It's not an investment. But we hedged here and we hedged the other half here. And in theory, what we could do, and we have a strategy in place, but let's say the market falls apart and down goes NVIDIA, down goes Apple, down goes all of them, then we could simply start to sell some of our QQQ, which makes us net short. So in theory, this is how you stay afloat and how you profit in bad markets. I want to share for a moment some tickers that we very simply hold because they've done nothing wrong. So here's an example of Boston Scientific, a medical device maker, short-term uptrend, long-term uptrend. The funds are accumulating still, according to our research. You're you're in you're within like a percentage of all-time highs. It's done nothing wrong when the market's been really nauseous. And very simply, the market is actually down year to date, the stock market. Boston Scientific year to date is up 17%. Pretty wild, right? I'll give you one more example and then I'll turn to you, Mike. So here's gold. Gold's extended and it had a little mini pullback, but short-term uptrend, long-term uptrend, it's doing everything right. And it's up 11%, 11% alpha outperformance to the market plus. And it's still acting as a strong safe haven when things like Bitcoin certainly were not. So obviously these are could change at any moment. Mike, any thoughts on hedging or final thoughts on just things we're holding in regards to the strategy?
Yeah, I'll just throw it out kind of from a big picture standpoint. If you look at what we have and what we've shed, we're not all or nothing. We're not like a light switch turning on and off. You could see that there are, how would you call it, basically levels of action we take as the market dishes out what it's going to dish out. We respond to it. So that's why, for example, we're in these positions that are acting well. They're doing nothing wrong. But say gold, for example, what if the market really does start to fall apart? I'm guessing, Scott, it might take gold with it, for example, and that's when we'll take action. Any thoughts to that?
Yeah, I think if you've seen any history show, meaning the market, if there is extreme volatility and extreme pressure, people are going to sell their gold shares first and then their gold second. And everything gets thrown out the window. And what gets kept in extreme bear markets are treasury bonds, cash, shorting. That's what gets kept. Everything else gets thrown out the window. And sometimes staples and food and restaurants, they tend to hold up because at some point, if you're not going on vacation per se, but maybe you'll go out to a restaurant. So there's like that safety net trade. And I want to stop here on seasonality for a minute. Some people love this. We follow the trend. This is just some years it works great, some years it doesn't. But I want to share this with you is traditionally market seasonality is January's a mixed bag. February tends to have historically some mid February, you get some kind of typical correction. We definitely got that. And then the market then signals, okay, well, it's March 5th and this is mid-March. So could the market have one more uncertain, sharp pullback down? That's what seasonality tells you, that this is not the end of the pain at the moment. And then at some point you get some version of recovery. That'd be great. And again, that's going to be less revisions of GDP or growth slowing and less, again, I assume this would be inflation staying tame and growth being fine. But at the moment, that's not what we have. You're having these very large multinational tech companies that sell overseas that are going to have some pressure with reciprocal tariffs. So the question then is, okay, well, what is the pullback? And the answer, no one knows, but you want to keep them really small. And that's just speaking from personal experience. There's nothing worse than being down huge because you have to recover huge. So if we're down 5, which is totally normal, then you just need a 5.3% return to break back even, which is a couple days, maybe a week, sometimes even less. But if you fall 10, you need 11. If you fall 20, like a lot of tech stocks have, you need 25. If you fall like Tesla, where you fell 40, You need a 66%, 60, almost 67% return. So we're just trying really hard. Why we're playing defense is small losses, big gains, and keep your capital protected so you don't have to kind of swim upstream during very difficult times and having to wait all that time to recover. Why not just in a commission-free world, in a retirement account, there's no taxation. Again, talk to your professionals. This is just a couple clicks away from protecting yourself if things got significantly worse. I'm going to move over here and just the why we do what we do, why we believe what we believe, why are we passionate about this, why do we shoot videos, why do we, in an upmarket, we're all heroes, bottom left to top right. If you're making lots of money, this is the reality is life's easy. We're just not in that environment anymore. And when we are in that environment, we tend to perform quite well. When the market's sideways, which I would share that we've probably been in that for several months, almost a year, I feel like there's only this select stocks that did well, and we own things like Meta and a couple other ones that were doing quite well. But a lot of stocks under the surface have been awful. And this is a choppy environment where it's no one's making lots of money, and most people are losing lots of money. And Twitter's getting kind of crazy, or X is getting crazier and crazier, in my opinion. And then eventually we land after a 2 year bull market into a massively terrible downtrend. And this is where, if you'll notice, the trend roadmap corresponds really well with this, is we are protecting lots of capital because we're heading into a lot of stage four declines. And stage threes are just a warning shot for us. So that's why we lighten up. And we, in stage four, we're like, all right, that's it. We're hedging, we're protecting. We want to see more stage twos, math to tell us before we deploy more capital. And we did. We'll talk about a couple of what's actually holding up in a second. But Mike, any final words on our strategy of trend following using flows data and math of trend?
Yeah, a lot of it is math, and especially when you look at that last chart with, what drawdown, what you need to gain to get back to zero. It's all math, and it's so fascinating. But I do want to point out, just to be super clear, that we don't know what's going to be happening. We've said this probably the third time now. So we don't know if the downtrend we're in right now, is it going to sustain or not. We're ready either way. If we end up with one of those V-shaped recoveries, we're ready. Our algorithm will get us back in. Maybe not at the perfect time that everybody would like, at the exact bottom, because nobody knows the bottom. So I just want to emphasize that we just don't know. We're not predicting. We are monitoring it closely and prepared to take action.
Perfect. So very simply, the stock market scores a 5 out of 10, not great, right in the middle of the road. The S&P is very similar to what the Nasdaq looks like. It's a little bit stronger, but it's again, you're under pressure and you'd really want to hold some of this support here, or unfortunately, the market likes to take, what do they say, this like the stairs up, and then some people say escalator. I like trapdoor because I feel like
Yeah.
it's fast and it's ugly. And very simply, if we look at the where the strength is in the market, it's in VEU, it's in international where we have a full position. It's in interest rate plays like real estate, staples, and healthcare. Those ran really fast, so we don't have a ton of exposure. We do have things like Boston Scientific, which it gets us there. We did add some additional kind of food related items. But what's been getting hit the hardest is discretionary. It's small caps, which we're out of on a break, tech's on a break, energy's on a break. I mean, this is a clear indication of like not great. I mean, we want to be clear, red is really, or pink's really bad. Microsoft not doing well, Google not doing well, NVDA not doing well. What's doing well? Eli Lilly, healthcare. Berkshire Hathaway's had some volatility. Financials got hit yesterday, but that's fine. Financials are holding up to the right. We still have some of our financial exposure. We moved a little bit more to insurance stocks, which you're not going to not protect the house. So the market's screaming trouble. Hopefully, it's some version of a bounce relatively soon, but if not, this could get way uglier. If we stop here, so very simply, our process. Thank you for being a member. We follow trends, we follow big money, we follow risk management rules. We're doing that on display. We're not perfect. I want to be crystal clear. We're not perfect. The market is not perfect. We just don't want to personally buy and hold and lose 25% of our hard-earned savings. I don't want to do that. So these rules and this process is embedded into our Invest with Rules situation. So thank you. Hello at investwithrules.com. If you have any questions, we're here to support you. Thank you for being a member. If you're interested in being a member, just reach out hello at investwithrules.com. This is where we don't want you or your friends or your loved ones to get steamrolled if something gets really ugly. Number two, if you're like, this is great. I don't have the time. I really could use someone looking over my shoulder, or even just very simply, hey, I got these positions that are causing me to real concern. I'm up at night. I've heard it from some people about NVDA a couple weeks ago, and now more recently, it's like, oh my goodness, what do I do? If you're like frozen and you're stuck, just email us hello at iwradvisors.com. Feel no pressure. We do have a fiduciary service where we try to help people avoid huge drawdowns. Again, if we are in this sustained downtrend, you're going to be quite happy with us and our process to manage risk. But in general, again, we want you to be successful no matter what is right for you. So I want to say first, thank you. Email us hello at investwithrules.com. I'm going to stop there. Mike, final words.
Thanks, everybody. Appreciate you being members and mind your risk. That's, I guess, my bottom line to all this. Mind your risk.
Again, thank you for being a member. Have a really good day. Thanks. Bye-bye. I hope this helped you kind of identify some either uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com. Thanks so much.